and we will go ahead and get started. We may have a few more people kind of come in, but let me go ahead and get started. It's 1 o'clock, so we can push through this here. Thanks guys for joining me. It's going to be kind of a small group, but the only people that were invited to this were the people that registered or attended the webinar I gave. And if you were on that webinar, if you watched the replay video, you'll know that when I went to demo the Validea site, it kind of got hung up. So everyone should be seeing my my screen here and hopefully hearing me loud and clear. If you're not, please just, I'll unmute. I have you all on mute, so I'm admitting someone else here into the room. I'm gonna ask John, let me see, I can't unmute him. Let me just see if I can unmute, Jeff, can you can see my screen and you can hear me okay? Yes. I just unmuted you. Okay, great. All right, great. Okay, so let's get started. So yeah, I'm gonna spend the next 25 to 30 minutes walking you guys through the Validea research site. We do have some subscribers on, I know. So for some of those folks, this was gonna be more like a recap. For those that aren't subscribers to Validea, some of this will be new to you, and hopefully you see some value and some interesting tools on the site that you might be able to use in your investment research process. So just at a high level, Validea is a quantitative investment research firm. We've been running quantitative investment strategies since 2003. When we started the firm, we started following strategies based on great investors. Most of you know that because if you were on the webinar or watched it, you know that those are the guru strategies that we started with originally. And since then, you know, we've developed other quantitative type of strategies, ETF strategies, and we'll walk through some of those today. But just two of the things I wanted to point out on the homepage is there is a product overview. When you're not logged in, there's a product overview link and there's some introductory videos here. So for people that are a little less familiar with Validea, I would encourage you to, you know, look at those things because the product overview is just kind of what it says it is, an overview of the various products and tools. And then the videos are sort of short, what I would say 2 to 3 minute tutorial demo videos about the different sections of the site that we're going to walk through today. But let me just log in. So the first thing I wanted to show you, which is I think sort of the core of the stock analysis, or I guess it's the core of anything to do with the gurus, people like Warren Buffett, Peter Lynch, those strategies that we have extracted and computerized, sort of the foundation of those strategies sits in this guru analysis tool. And what guru analysis allows you to do is for any stock on the US market, you can see how the various strategies score the stock and why the stock gets the score it does. So if we look at Microsoft, for example, here what you're seeing is you're seeing Microsoft and how that stock scores through the lens of the 22 different models that we run on Validea. One thing I should know is that the site is broken out into our standard and professional versions. So what I'm showing you today is the professional version of Validea. This is the higher level version. It includes all the strategies we run, depending on what the investor is utilizing on our site. They may decide to subscribe to either the standard model, which is cheaper, or the professional model. But because I wanted to show you everything, I'm showing you the view that you would see if you were a professional user, which is a higher level subscription product and cost. But here you're seeing how each and every strategy scores Microsoft on a scale of 1 to 100%. If you know, you're never going to find a stock that passes 15 of these models. All these models are very different. We have a lot of value strategies, we have growth strategies, we have strategies that use momentum, and then we have like an earnings estimate revision strategy. So they're all using a different set of criteria, and able to analyze stocks through many of these different angles. What I would say is if you see a stock, and Microsoft is a good example, that scores, 70+% from 4, 5, 6 models, that generally gives you a sense that at least fundamentally the stock is looking good based on the set of strategies that you're looking at. And this one, what you're seeing here to start, this is the Pim Van Vliet model is like a large cap, low volatility / multi-factor model. The twin momentum model is looking for stocks that have both fundamental momentum and twin momentum. You have Lynch, which is growth at a reasonable price, the O'Shaughnessy strategy. Here, let's look at this. So I just clicked on the Jim O'Shaughnessy row, and I wanted to see if this was his cornerstone. I'm guessing it's a cornerstone. Okay, so it's a cornerstone value strategy. So when you click into each and every one of these models, what you're going to see is the details behind why the stock passes or fails a particular strategy. So as I come down here, this model that we're looking at is based on Jim O'Shaughnessy's work and what works on Wall Street. And it's a cornerstone value strategy. I actually thought that maybe Microsoft would have passed the cornerstone growth model, but the cornerstone growth model is a little bit more oriented towards smaller companies. The value model is the one that looks at. So this is a pretty straightforward, simple strategy. It's looking at market cap, cash flow per share, shares outstanding, trailing 12-month sales, and then the dividend. It actually fails the dividend criteria, but just even though it fails the dividend, it doesn't necessarily mean it's a 0 score. It still scores relatively highly according to the O'Shaughnessy model. But let's look at another one. Let's say the Pim Van Vliet. So here, all I did is in the drop down is I switched it to Pim Van Vliet. And then what you're seeing is how Microsoft scores and why it gets 100% according to this specific strategy. So again, it starts with market cap. It looks for the largest stocks in the market. It then looks at the standard deviation of the stock's volatility over the last 3 years, and it wants to see lower standard deviation, so in the bottom 50%. It then looks at 12-month minus 1 month momentum, the net payout yield, and it does a final rank here. It does a final rank of the security. So Microsoft is in the 4th percentile of all stocks in the database. So I could go like on and on with showing you these different models, but I think the point is that for people, that really want to see the reason why the stocks they're interested or the stocks they hold, how they score fundamentally, how they stack up according to these strategies. I think this GRU analysis tool, offers a good way to do that. You can either get sort of a quick snapshot by coming into this page and typing in a ticker symbol and just seeing how stocks score. Or if you want the details behind it, you can click down and obviously get more details like I just showed you. Sometimes it's not only why a stock passes, but why not. And as you sort of learn more about these strategies or potentially even gravitate towards 1 or 2 strategies that you really like, that can be a quick way to say, okay, how do the stocks that I'm interested in, rank based on the strategies that are appealing and attractive to me as an investor. So that's the GRU analysis tool. The reason I like to start with that is because I'm just going to admit someone in the waiting room here. Hold on. Okay. The reason I like to start with that is because that is really like the foundation or the core of when we build portfolios off of these strategies or we run stock screens, they're all basically being keyed off of this scoring system. So let's transition over to the portfolios. As I mentioned, we have the standard strategies and the professional strategies. So those are broken out here so you can get a quick view of what strategies and what package. But I'm just going to go to the all portfolio page, which is going to show all the portfolios in one view. And what we've done is taking those strategies and these strategies you see on the screen, the strategies based on these great investors and also academic papers that we've extracted strategies from, we've constructed and created what I would consider very focused model portfolios that hold the top scoring stocks according to each of these models. So we run 10 and 20 stock model portfolios, and we run portfolios that are rebalanced monthly, quarterly, annually, and tax efficiently. So let me just spend a minute on what all that means. So obviously the number of stocks is pretty simple. You have either 10 or 20 securities. We always, with those portfolios, those portfolios are always going to hold, as of the rebalancing period, the top scoring 10 or 20 stocks according to the model when those portfolios were rebalanced. Sometimes in these portfolios, you will find stocks that don't score 100%. But when we developed and created this system, we didn't want to create model portfolios that sometimes had one stock, sometimes had 50 stocks, sometimes had 4 stocks. So to make it something that we thought investors could use, we always will stuff the portfolios with 10 or 20 securities. And they're the 10 or 20 top scoring securities according to the model on any rebalancing date that we rebalance the portfolio. Just one little thing in there is we break ties. So sometimes you might have, let's say you have a model that scores 50 stocks with 100%. Something like the Lynch model might do that, or even the O'Shaughnessy or Greenblatt models might do that. So the way that we break the ties is we use a composite score. We basically say, okay, across all the models that we use, we have a composite score, and the way that the ties are broken is the stocks that score highest according to the ones that get the highest composite score. So that's our tie breaking system. In terms of the rebalancing, what we mean here is that we track the portfolios that are rebalanced monthly, meaning they're rebalanced, it's actually on a 28-day cycle. So they're rebalanced once every 28 days. So the model basically will say, okay, what stocks have fallen in score? Let's replace those with the higher scoring securities. So we do that on a monthly basis. We track performance of those models. We track the performance of quarterly rebalance strategies. We track the performance of annual rebalance models. And then we also have a tax efficient system. So basically with the tax efficient strategies, let me just click on that. So what you're seeing is these are the models, the 10 stock model portfolios that are rebalanced using our tax efficient overlay. And what the tax efficient overlay seeks to do is it seeks to harvest losing positions and hold long-term winners until the 12-month mark. You wouldn't want to be investing in a portfolio, say, and at the 10-month mark you have a stock that's up 80%, and then sell it in month 10 and realize the short-term gain if it's taxable money you're investing. So this tax efficient model is really set up to try to be more intelligent about the way that these stocks are basically being sold. And that was essentially developed for, taxable money, if that's important to people, which for a lot of folks it is. So that's sort of the overview of the portfolio size and rebalancing idea there. And then we do show performance. So going all the way back to 2003, what I would say here also in the spirit of being transparent is when we started in 2003, we started tracking a set of strategies, and those were real live model returns. Starting in 2006, we started, well, let me restate. Anything after March of 2006, so the Twin Momentum Investor Model, the Patrick O'Shaughnessy Millennium Investor Model, the Earnings Revisions Model, those strategies were developed later on, and we back tested the performance to those inception dates. So what I'm trying to say is there are models between 2003 and 2006. Those have always been live models on the Validea site. Models after 2006, they were developed in the future, and then we back tested them back. And when I use the word back test, it's not back testing in the sense of optimizing strategies. What we try to do is stay as close as possible to the strategy as it was outlined in the book or academic paper. So it's not, let's take the Pim Van Vliet model that he highlighted in his book and tweak it until we get the best performance. It's, let's stay true to the model that he outlined in his book. We captured it, we codified it, we know it's based, and it has his own back test in his book, went back to like the 1920s, I think. But that's essentially what we're trying to do, is find these strategies that have worked over time, capture them in the Validea system. And then in some instances, when we do introduce a new model, we want to try to test it as far back as we can, so we can show investors how this strategy is done sort of in the current day environment And we put that on here on the Validea site for people to look at. Okay, so when I go into one of these models, now all the portfolio pages are basically going to be the same look and feel. So I'm just going to focus on one. But what I did is I clicked into the price to book to growth investor strategy. This is based on the work of Partha Mohanram. He's a professor at the University of Toronto. And by the way, he just did a great podcast with Toby Carlisle on the Acquires Multiple podcast. If anyone's interested in what Mohanram is doing, and just it was a really good interview. They actually talked about the Validea model and how it's been one of the best performers over the past 10 years within the Validea model lineup, and sort of some of the reasons why. I won't necessarily go into that other than saying, you know, it's been a really good environment for growth-like strategies. So this strategy has obviously been a beneficiary of that. But when you come into this page or any model portfolio page, what you're seeing is the long-term performance chart of the portfolio, some statistics here. You also have the full return history. So we are looking at the 10 stock tax efficient model. So you see the full performance history here. This is ending with Mohanram. This is where the live model returns essentially stopped. What I was saying before, from 03 to basically 06, when we implemented Mohanram, all those model returns are live model returns. After the Mohanram was introduced, the models on the site, they do include some back-tested performance, just to reiterate that. So you get the full performance history here. As you come down, you're going to see the current portfolio holdings. So here are the stocks in the portfolio. You get the date they were added, the score when they added, the current score, the starting price, the latest close, and the return since being added to the portfolio. We have a performance view and a fundamental view. So if you want to change to the fundamental view here and see different fundamentals on the company real quickly, you can do that. We also show you historically, going back to each rebalancing date, what the portfolio was holding at any given time. That's probably more detailed than 99.9% of investors want to see and dig into. But in terms of how a portfolio may have been positioned at various points in the market cycle, it could be interesting. Looking back to the end of 08 or maybe 2011 or 2015, particularly when there was stress points in the market, to see what the portfolio was buying and how those positions held up. That could be interesting. Obviously, that's reflected in the performance of the portfolio, but you would get to see it on a much more granular level if you switch to the rebalancing date, any past rebalancing date, to see what the portfolio was holding. And then coming down the page, we got our latest changes. So there was no changes. And that's due on the last rebalancing, which was June 26th. The next rebalancing is July 24th. And the reason there would be no changes is because with this tax overlay, it's set up to basically try to hold your winning positions. And I think what the portfolio would show you, if you look at the holdings, is that there's a lot of winning positions in here when we switch to the performance view. If I can get back to there. And so, we have two small losers in here. This one was just added, GlaxoSmithKline, and then this other company here, but it still has an 88%, so it still is going to stay in the portfolio. So as long as the portfolio still, or the strategy still scores the stock highly, even though it has a loss, we'll keep it in. So that's why there's no changes. But let's just contrast that with the 10 stock monthly. So this is what I'm doing here is I'm switching from the 10 stock tax efficient to the 10 stock raw monthly portfolio. This is one of the better performing portfolios year to date. The strategy is up 25% for the year on a model return basis. And when you come in here, I'm just trying to show you the latest changes. So there were two additions. Mobileye and Monster came in and installed building products, and this Star Surgical came out. So that's the model portfolio tool. I know we have investors on here that utilize this. And what I would say is, I'm an advocate for really trying to understand a strategy and making sure that you can believe in the strategy and it fits with your style as who you are as an investor, not just picking the top performing one, because inevitably all these strategies, I can guarantee you, will go through periods of underperformance and potentially long periods. So if you're trying to implement one of these on your own, that's hard enough. It's, sometimes in and of itself, but then when the strategy falls out of favor, if it's a good long-term strategy, of course you want to stick with it. But if all you're doing is investing based on, what has worked because it's the best performer, you may not be able to stick with it when the time comes that it underperforms. So I would just encourage people that are thinking about following one of these strategies to kind of look at them and try to understand as, best as possible why you're investing in the strategy and the types of stocks that it's seeking and why you have conviction in it and believe in it. On each of these pages, I should just point out there's going to be, supporting material. So there might be a user guide. A lot of these have a user guide and or a video tutorial. So on any of the models, you'll see a video, which it's like a 3 to 4 minute video around. There's the explainer video right here. When you click on that, that'll bring up another browser over to YouTube. I don't want to do that right now, but you can also watch those videos under instructional videos. So you're going to see a lot of links here where there's instructional videos, guru strategy videos, ETF strategy videos. So we've really tried to use the last year to focus on this content and these videos to help investors better utilize and understand the tools and the research on Validea. So that's the model portfolios. The one quick thing is we do run, and this is kind of buried here. What I did is I clicked on industry and country model portfolios. Going back to that composite score that I was mentioning. So in the professional version, we do run what I would consider industry or sector-based portfolios and or country portfolios. These aren't going direct investments in the country. These are filtering on ADRs. So we run a portfolio based on China. Our US one honestly hasn't really done that well. There's one based on Canada, the BRIC countries, Latin America, but there might be a little bit more value in the industry and sector ones where we try to say, okay, what are the top 10 technology scoring stocks using this composite score? And then we follow these portfolios on a monthly rebalance basis, or what are the top performers in healthcare? You would expect, again, technology and healthcare has been, those have been very strong industries. So, these portfolios show very good performance. I'm just letting you know that these are here if someone wants more focused industry exposure within the model portfolio setting. Okay, sticking with our guru theme, I'm going to go over to the guru stock screener and just show you another way that investors can generate investment ideas using this system. So what you can do here is you can screen for specific strategies, combine strategies, or look for stocks that pass multiple strategies simultaneously, and then add in your own strategies if you want. So let's say you're a Peter Lynch fan. So you like Lynch, you like his growth at a reasonable price type of strategy. It has some growth elements to it. There's a value component in it with using the PEG ratio. But, if we screen on strong interest, you're going to get way too many stocks here to know what to do with. I mean, there's probably maybe like 300 or something like that. So you could do a couple things there. You could say, okay, let's combine the Lynch model with my other favorite investor, the Warren Buffett strategy. So what stocks pass both Lynch and Buffett with, some degree of interest? So, here we have a pretty concise list. So we just went from a couple hundred to, a handful. Cisco's in here, Progressive Eye Care, that's my eye care, Progressive Corp, Medfast, some names, United Health Group, some of these names might be familiar to you. When you see a ticker symbol on the Validea site, that's going to always bring you back over to Guru Analysis. So here what I did is I clicked on United Health Group. Now it brought us over to our Buffett strategy, and we can see why United Health gets 93% based on our Buffett model and all the criteria that go into it. So that's one way you can use the Guru Stock Screener, is to screen on or for stocks that pass strategies that you want to combine. The other way you can use it is you can look for stocks that, let's say, pass multiple strategies simultaneously. So let's say you just said, I don't really care what gurus, but I'm really just looking for stocks that sort of seem to be sound fundamentally using the Validea system. Let's go 6 summer strong interest, which means these are going to be stocks that pass at least 6 models with generally an 80% score or above. So coming in, you're going to get, a reasonable list to deal with. That's not too many. But again, some of these names you'll be familiar with, some of these you probably never heard of. That could be a great thing with screeners is, it could help you identify names that you would have otherwise, maybe never even known about. All of these are sortable. When you sort on our site, we don't allow sort ascending and descending. It just sorts ascending. So it's kind of a pain sometimes, but what I did is I clicked on market cap and then I came down and, these are the largest companies in that screen, looking for stocks that pass 6 or more models with summer strong interest. The other thing you can do is you can continue to further refine. So you can basically say, okay, let's just look at companies in the technology sector. When you click on that, you're going to be basically limited to the companies in the tech sector that pass at least 6 strategies. Let's bring it back to the full list. So I went all sectors. And then you can start to add in your own variables, which I think it gets a little in the weeds here, but for people that like enterprise value to EBITDA, or they know what shareholder yield is, or they know what net payout yield is, or they want to see the long-term PEG ratio. There's what we try to do is have the basic stuff in here. So if you want to basically just, filter on a certain market cap size or something like the price to book ratio, the standard stuff is in here. But then what we try to do is think through what are the other more unique criteria that we know of that investors might be interested in. So some of those I just highlighted. The acquirers multiple. We have a value composite percentile, which is based on Jim O'Shaughnessy's value composite work. For those that have read What Works on Wall Street, there's some under the growth and profitability. So there's projected long-term EPS growth from Wall Street. Could be interesting if you want to make sure that, Wall Street analysts aren't too accurate, but sometimes that can be valuable. If that's something you value. Multiple price and relative strength stuff. So there's 1 month relative strength, 3 month, 6 month price below or above the 52-week high. And then you've got some quality and ownership criteria in here. So some of the more interesting things I think are the 10-year average return on equity, return on capital, weighted average cost of capital. You have insider ownership. You also have F score and the G score. So if anybody's familiar with the Piotrowski strategy, or the G score comes from Mohan Ram, you can basically introduce those into your screens as well. So that's the Guru screener. Let me just see here. Oh, the other thing that might be interesting is, and these are relatively new, but I'm going to go, so they're here. They're in the cheap, under popular stock screens. There's the cheapest values. It starts with cheapest value stocks and then goes down, but I'm going to actually scroll down to the footer here. It's a better, here's more. So these are interesting. Like if you just want quick sort of determined screens. So top Warren Buffett stocks, top Benjamin Graham stocks, top Peter Lynch stocks, top Joel Greenblatt, highest overall factor scores, which we'll look at our factor report in a minute, cheapest value stocks, cheapest. So like, for example, highest shareholder yield stocks, which shareholder yield is a concept. It's all the ways that a company can basically return cash to shareholders. It combines the dividend yield, net buyback yield, and debt paydown yield. But this is a quick way to screen for high shareholder yield stocks. There's a video that sort of talks you through what shareholder yield is. And then there's, a list of 25 names or so that are the highest shareholder yielding stocks. And so those are just pre-populated, predetermined, more popular screens that might be interesting. If the Guru stock screener is just a little bit too detailed for you and you're kind of struggling using it, maybe those popular stock screens could be helpful to you. So that's the guru focused portion of the Validea site. I think that's what we're mostly known for. I think when investors sort of come or learn about Validea, most of it is about taking these strategies that have been publicized by great investors and or written about in academic papers and utilizing the tools and the research that have those models in them. But we have developed other parts of the site and other, I guess, tools and things. It's all based on quantitative modeling, but let me just show you what some of those are, because those kind of are buried and you may find them somewhat valuable as well. So here I'm looking at our factor report. So what our factor report does is for any stock, it's basically looking at the stock through the major investing factors, and then we go one level down and look at specific, more specific factors within that higher level factor. And I'll explain what that means in a minute. But the one thing I want to just point out is that if you are on the Validea site and you're looking at a company, let's say, when you're on the guru analysis, just remember that when you're looking at a company in detail, you're only going to see the company description here. When you go to the factor report, so I'm looking at Apple through the guru analysis tool, but then let's say I want to look at Apple through the factor report, what can be useful is these boxes at the top. So they're just giving you quick, it's, you know, it's a rolled up snapshot of important price, market cap, and related fundamentals that, you know, just a quick looking at those can be useful, and the company description is on here too. So I'm just pointing out that, you know, if you want to see like stuff like what the price of the stock is or the market cap and the sector and the industry and the 52-week high and 52-week low, you have to come into the factor report to do that. Scrolling down this page, what you're going to see here is basically from, we're looking at, yeah, it's Apple, not Microsoft. So we're going to see the overall rank for Apple, and then we're going to see how Apple scores through the various factors. So value, it's not a cheap stock. It was maybe at one point a lot cheaper. It's not now. And then, so it gets a 33%, higher is better. But you get to see sort of based on the percentile scores on these other metrics. So the PE ratio, price to book, price to sales, you know, how it stacks up, and then the total value exposure within this factor report. So value, not so great, but quality, very good. So that kind of makes sense. You know, Apple's really got a lot of cash, high ROE, return on capital, you know, really high margins, it's got EPS consistency, sales consistency is kind of in the middle. So it gets very high in the quality score. Negative quality is kind of looking at the things that you would want negative, things that would indicate that there's like negative quality in the company, high debt, projected EPS decline, lots of cash flow deviation, negative momentum. So from a negative quality score, it's not bad. It's got a lot of momentum. So it's been a very strong performing stock using price momentum and fundamental momentum, which is a concept that comes from one of our strategies on the site. And then there's also low volatility, which to derive low volatility, we look at the standard deviation of the stock and the beta. So this is just another way when you're looking at a company or companies in your portfolio, or even companies on the Validea site, maybe that show up on the screener or in the guru analysis, to say, okay, how does this stock that I'm interested in, how does it, you know, stack up using the popular or what I would consider more proven factors in investing. Okay, so there's that. I'm going to now pivot over where 35 minutes, hopefully this will be done in about 10 more minutes. I'll go quick. I'm going to pivot over to the ETF model portfolios. And here it's, again, the concept of following sort of systematic strategies within a model portfolio context, but it's done using ETFs. And we have really 3 different types of ETF portfolios that we track and that users can follow on the site. We have factor portfolios. So these are looking across ETFs that have certain factor exposures and holding like those ETFs that are exhibiting those exposures. So here we're looking at, I just clicked in, we're looking at ETFs that are exhibiting the most momentum at the current time. So here are the names in there. You got, the 5 ETFs that were at least as the last rebalancing. So we added the value and the pure growth ETFs. These are based on Invesco's factor ETFs. So it's the pure growth, mid cap quality, small cap pure value, small cap pure growth, and mid cap pure growth. So that kind of makes sense, I guess, off the bottom in March. You know, it's more these small cap, mid cap names that have done pretty well. And so that's what this portfolio is trying to basically get at here. So there's, under the ETF portfolios, there's the factor portfolios. We do run them long only and then with trend. Anytime you see trend, that means that these portfolios have the ability to go to cash if the overall trend gets negative. Excuse me. So that would be something that if you're interested in sort of trend following and overlaying a trend following technique on various strategies, that's what that basically is doing. And then coming down into here, you have sector portfolios. So this is kind of a little bit easier for me to explain. It's like what sectors are exhibiting the most value based on the holdings, what sectors are exhibiting the most momentum, or what sectors have the, basically when you look at like a composite type score, what sectors are scoring highest using a composite type methodology. So that's what these portfolios are doing here, and holding various ETFs that score highly. And then I think what probably within this section of the site is most appealing to investors that are interested in this is some of these risk managed portfolios. They don't have performance that is comparable to those other ETF portfolios, but they shouldn't, because they're really all risk managed. So what we're trying to do here is construct portfolios that really are trying to limit, you know, downside volatility and drawdowns. And there's various ways that we do that. We run a permanent portfolio, which is just very simply a portfolio that holds stocks, short-term bonds, long-term bonds, and gold. We run a modified version of that, which incorporates trend following. We have a strategy called protective asset allocation, which I'll just highlight that because this is another way that momentum can be used in ETF selection to sort of bring you into the areas of the market that are performing well, but try to protect to the downside when things aren't. And so what this strategy basically does is it looks across 12 different ETFs, and then it will select the 6 ETFs that are exhibiting the strongest momentum. So it's looking at S&P 500, Russell 2000, NASDAQ 100, European equities, Japanese equities, emerging markets, long-term treasury bonds, high yield bonds, corporate bonds, commodities, gold, and real estate. And on a monthly basis, it looks at what 6 ETFs are exhibiting the highest level of momentum based on 1 year look back momentum. And then it's selecting those holdings that have the best. But what the strategy also does is when 6 or more of the asset classes are exhibiting negative momentum, it will actually look to raise cash. So there's a systematic sort of flexing of the risk on and risk off exposure based on how the collective group of these asset classes are performing. And this is, there is an academic study on this, and there's also an explainer video here, but I'm just highlighting like a different way that you can kind of look to control and protect to the downside, but also not be, you know, like 60% bonds all the time. This is what this strategy is trying to do. And it's actually been quite successful at being, you know, doing okay. I mean, this year is actually, if we were to end this year being 5.1% down, it'd be the worst performing year for this strategy, at least based on our testing, going back to 2007. So even in a year like 2008, and by the way, I'm not surprised about that, because if you think about the largest decline, well, the fastest 35% decline ever in history from basically mid-February to let's say late March, and then, you know, this reversion back up, any model that's using like a momentum statistic, it's going to have some difficulty when you have that type of dramatic, significant moves in such a short period of time. But if the market continues to do well, I mean, this portfolio will continue to gravitate towards those more those asset classes that, you know, are performing best and exhibiting the most momentum. Okay, so that's the ETF model portfolios for people that want to look at those. And then the last thing I'll show you just before we wrap up is we do have an ETF factor report. So here is, it's taking that factor report I showed you on stocks and applying it to ETFs. So it's looking within the holdings of these ETFs, and it's saying, you know, how much value exposure does this ETF have? How much quality exposure do the holdings have? So if anyone's an ETF holder and you use ETFs in your, you know, investment process, and you want to see how your ETFs stack up based on factors and also their sector and industry exposure, you can use this tool to do that. The other thing is at the bottom of this page, which might be interesting, there's a list of comparable other ETFs that have similar type of factor exposure. So let's say, you know, you're looking at an ETF and you're like, this is interesting, I really like this ETF, but I'm kind of, maybe I have too much of it, but I don't know, I want to allocate towards a similar type of ETF maybe, or maybe I like this ETF strategy, but this ETF sort of seems too expensive. These are maybe some ideas that would be alternatives, if you will, that have similar type of factor exposure. There's also an ETF factor screener. So that's taking, oh, you know what, this page, it'll work for you guys, don't worry, I'm cookied or something. So when you go to the ETF factor screener, that'll come up for you. It's just for some reason for me, I hit that error sometimes, but it's basically taking the ETF, it's taking the guru screener concept and applying it to screen for ETFs, but based on these factor scores. So you can utilize that screener as well. There is a trend following tool and also a market valuation tool. Those are there. I'm not going to spend too much time on those just because we're running kind of long here. But if anybody's interested in trend following and or seeing like the market's valuation, you can utilize that tool to see those things. So there's that. And then the last thing I'll just say is we do a lot of content creation here, as most of you probably know. Some of you may even come to us from our blog. So we write, and we're actually in the process. I'm actually really excited about this. You guys are the first people to know. We're in the process of redesigning our blog, which is basically just like a running list of articles. Some of these are original articles, but we also do a lot of curation here. So, you know, every day we're trying to summarize interesting investing articles that we see around the web. And we've been blogging since 2008. So we have a lot of content and it's not really displayed in a great way for the investor. So our new blog redesign is almost going to be like a Netflix type of, you know, look and feel, where we'll have categories. So we'll have, you know, value investing. And then we'll have, you know, our most popular post based on value investing. And then we'll have behavioral finance and psychology. And we'll have our most popular. So the blog homepage will be much more designed to bring up the material and the content that we believe is, you know, important and investors can learn from. And then Jack Forehand and I, as some of you guys also know, we do have a podcast. So it's called Excess Returns. You can watch it on YouTube and or Apple Podcasts. And we're always, we kind of got started on the podcast game late. So, you know, we're sort of in the building process of that. So anyone that listens to podcasts that, you know, wants to support us by subscribing or whatever, we you know, we appreciate that too, because every listener helps and every like helps in terms of growing your podcast. So I'm going to end this, and I'm going to go ahead and I'm going to go ahead and I guess, well, here's what I think we should, here's what I'd like to do. I'm going to send out an email to you, and in that email, there's going to be a link to sign up to Validea if you're not a subscriber and if you're interested. But again, I'm not this, there a lot of the stuff I've showed you, most of the values behind a paywall, but there are some things in front of the paywall. So if you know if you don't think you're going to use Validea, but you might maybe once in a while come and like want to see how a stock scores, and just don't sign up because it's not going to be worth your money. But for those that are interested, like I'll send you a link. The link will be in there. You can sign up if you want. But then I'll also send there's a calendar invite, online calendar invite thing. If anyone wants to do a one-on-one call with me to learn more about how, you know, what we're doing here and how you might be able to use Validea personally, if you're not a subscriber, or even if you are a subscriber, how you might be able to get more out of it, you can schedule a one-on-one phone call or video conference with me. I'm willing to do that. And, you know, we do manage money through Validea Capital Management. So for people that are sort of less hands-on, but like the philosophy here and are interested in, you know, learning about Validea Capital, you can do that too. So I'm not going to unmute everybody just because I don't know if that's a good use of everyone's time. And I also don't know without, like, there's some last names on here and stuff, and I just don't know about that. So and none of you guys really know each other, so I'm not going to unmute. I hope that's okay. I'll just use the email follow-up to you with the calendar invite as a way to further engage, you know, you guys, if you're interested in learning more here about Validea. So with that, I think I'm gonna end the presentation. I actually had more people in here than I thought. I didn't, you know, I had like, we had like maybe 70 people registered for the webinar. About half showed up, which isn't bad. And, you know, there's a decent number of people that have kind of come into this Zoom meeting invite. So, you know, maybe I'll do more of these in the future because there does seem to be enough interest where people are interested in this stuff. So, okay, so I'm going to end the meeting. I appreciate everyone's time today. Have a good weekend. It's almost 2 o'clock on Friday. So I hope everyone has a nice, enjoyable weekend. Take care. Thank you for watching.